Okay, let's talk about building wealth for the future. You know, having that nest egg so you can finally relax. We all want it, right? But the whole world of investing, man, it can feel like this super complicated game that only Wall Street pros can play. But what if that's totally wrong?
Yeah, what if the absolute best way to invest your money was to do, well, almost nothing? I know, it sounds totally backwards, right? Kind of crazy. But stick with me here, because the data, the actual numbers, they tell a really surprising story.
All right, so first up, let's picture the classic image we all have from movies, you know? The slick Wall Street trader, surrounded by glowing screens, yelling into a phone, making these genius stock picks. That's the world of active investing. The whole idea is to be smarter, faster, to constantly buy and sell, trying to outwit everybody else and, beat the market.
And it's a great story, right? The lone genius who can outsmart the entire system. But is it actually true? I mean, when you stop looking at the Hollywood version and start looking at the cold, hard data on how these professionals really do, well, the reality is kind of shocking.
And hey, we don't even have to guess. There's literally an official scorecard for this stuff. It's called the SP Viva report, and it comes from S&P Dow Jones. For more than 20 years, they've been tracking one simple question. Do the professional fund managers, the people paid big bucks to pick stocks, actually manage to beat the market? Let's find out. So, after watching thousands of these funds for 2 decades, what did they find? What's the big number that kind of sums up this whole debate? It's this. 64%. Just let that sink in for a second.
So what is that 64%? Well, according to that S&P report, it's the average percentage of professional fund managers who failed to beat the S&P 500 index. In any given year, almost 2/3 of the experts lost to the simple market average. I mean, think about that for a second. Most of the time, you would have made more money by just buying a fund that tracks the whole market and then going to the beach.
And just to be clear, this isn't like they just had a bad year or two. This is the long-term trend. It's the norm. Year in, year out, the data tells the exact same story. The huge majority of people who are paid to pick winning stocks simply don't. It's like the game itself is rigged, but not in the way you'd think.
So that leads to a pretty obvious question, right? If these experts, these really smart people, can't win consistently, why is it so dang hard? Are they bad at their jobs? No, not at all. The truth is they're fighting against 2 invisible forces that are just incredibly powerful.
First, there's some basic, unavoidable math. And second, there's the quiet but absolutely devastating impact of fees.
So the Nobel Prize winner, William Sharpe, laid this out perfectly. He basically said, look, think of all the active investors out there. Together, as a group, they are the market. So before you account for any costs, their average return has to equal the market's average return. Makes sense, right? But then you add costs, fees. And once you subtract those fees, their average return is guaranteed to be less than the market's. It's just simple arithmetic.
And those fees, man, this is where the real damage gets done. Just take a look at this chart from the SEC. That blue line shows a portfolio with a pretty low fee. The green line shows one with a 1% fee. Now, at the beginning, they look pretty close, right? No big deal. But just watch what happens as time goes on. Over 20 years, that tiny little difference turns into this enormous gap. It's like a tiny, slow leak that ends up sinking the whole ship.
And the SEC actually puts a number to that. That seemingly tiny 1% fee can end up costing a $100,000 portfolio almost $30,000 over 20 years, compared to a lower-cost option. That is a huge chunk of your money. It's gone, just eaten up by fees.
But wait, it gets worse. Here's the real gut punch. It's not just that you lost that 30 grand. You also lost all the growth that money could have generated for you over the years. That money was supposed to be working for you, making more money. The fees don't just take your cash, they steal all its future potential earnings too. It's a double hit.
Okay, so if trying to be a stock-picking genius is basically a losing game thanks to math and fees, what's the alternative? Well, it turns out the answer is to just stop playing that game, and instead you embrace a much simpler strategy, sometimes called passive investing, or my personal favorite, lazy investing. The core idea here is really simple. Instead of trying to find that one needle in the haystack, that one winning stock, you just buy the whole haystack. You invest in something called an index fund, which just holds a little piece of all the big companies, like all the ones in the S&P 500. The goal completely changes. You're not trying to beat the market anymore. You're just trying to be the market and get its average return.
And you know what the best part is? It is ridiculously easy to set up. A super common approach, sometimes called the lazy portfolio, is just 3 funds. That's it. You buy one that covers the entire US stock market, you buy another that covers the entire international stock market, and you buy one for bonds to add some stability. Boom, done. With those 3 things, you are instantly diversified across the entire global economy.
And now we get to the giant payoff. Remember those fees we talked about? The ones that were eating away at your returns? Well, with passive index funds, they practically disappear. I mean, look at the difference here. An active fund might charge you around 0.47%. A passive fund, you can find them for as low as 0.03%. That is a massive difference. And all that money you're saving on fees, it stays in your pocket working for you.
So it's becoming pretty clear that the secret to building wealth isn't about being some kind of stock-picking wizard. So what is the secret? Well, the real engine of growth, the most powerful force in all of finance, isn't genius, it's time.
And check this out. This fact about Warren Buffett is absolutely wild. We all think of him as the greatest investor of all time, right? But get this, 99% of his net worth was earned after his 50th birthday. His real secret weapon wasn't just being a good investor. It was being a good investor for a really, really long time. That's where the magic is.
And that magic has a name: compound interest. The idea is so simple but so powerful. Your money earns a return. Great. But then that return starts earning its own return. And then that money starts earning money. It's like a snowball rolling downhill. It starts small, but over decades, it can become an absolute avalanche of wealth. It's the ultimate reward for just being patient.
All right, so let's tie all of this together. What's the big takeaway from all this? Really, it comes down to a massive shift in how you should think about investing and building wealth.
Here are the key things to remember. 1. The data is crystal clear. Most people who try to pick stocks fail to beat the market. It's just a tough game to win. 2. High fees are a guaranteed drain on your money. They will hold you back. 3. Passive investing is a simple, cheap, and really effective alternative. And 4. The real secret sauce isn't stock-picking genius. It's giving compound interest decades to work its magic for you.
So, I'll leave you with this one final question to think about. After seeing all this, you have a choice to make. Is your main goal to play the game, to chase the thrill of trying to beat the market? Or is your goal to simply let the market build your wealth for you, quietly and effectively in the background while you get on with living your life? Honestly, how you answer that question could make all the difference.